Hello everyone and welcome to episode 186 of True Potential's Do More With Your Money show. Today I'm joined by a number of colleagues, Mark Henderson, Tom Robertshaw, Chris Leyland, where we're going to be discussing what's been happening in markets and also what we've been hearing from you, our customers, and also with our advisors. We'll also look at how markets have evolved over the recent 3-week period as well and bring to life some of those key themes as well, because it's been certainly an action-packed week, at least this week, from a market perspective as well. But maybe first, you'll see on the table here, there's quite a number of awards. It's been a very successful week for True Potential, but also for various aspects of the teams within True Potential as well. And Mark, maybe turning to you first, do you want to maybe give our viewers and our listeners an idea of the success that the teams have had this week?
Yeah, delighted to, Jeff, and it's good to see we've replaced the greenery, the plants, Graham's favourite plant, with the awards. And the purpose of showing them here is just to say thank you really to everybody who's helped us to achieve these awards this week, for those who voted for us and those who have provided the underlying service. So what have we got? We've got Best Retirement Advice Firm. That was from the Money Marketing Awards. I'm looking at Tom because he works for the Best Retirement Advice Firm, which is True Potential Wealth Management. Well done, and thank you, Tom, and your colleagues there. Also, we've got Money Facts Award here for Best Online Service. Now that underpins the technology, or the technology that underpins the whole True Potential system, Jeff. And that's really great to have it acknowledged, because it shows a level of engagement that clients have got with us using the technology that we continue to develop. And the last two, the ones that look like the towers here, they're from the Schroeder UK Platform Awards, where the True Potential platform, which is where all of our clients' investments sit and the administration's handled, got Best Platform Provider, but also Best Platform Service for the third year running. And that really is what we're striving to achieve. Good service for all clients who have assets invested with us. So the purpose is, yes, to acknowledge it, but also to thank every client who's invested with us. And we will continue to strive to provide them and everybody with the best service we can.
No, and it's certainly a great endorsement of everything that the business is wanting to achieve for our clients.
Absolutely.
Particularly. And maybe Tom, turning to you from that advice perspective in the first instance, clearly you've been speaking with clients in recent weeks. What's some of the key things that they've been talking about and wanting to discuss with yourself and the rest of the team?
I mean, of course, obviously, performance is one thing, and looking at cash ISAs and stocks and shares ISAs, and that's something that we'll cover, obviously, later on in this podcast. But I think I've actually realised over the years that the job that I'm in now is actually quite seasonal to some degree. Yeah. And what we often find is actually at this time of year, between now and November, we see a lot more drawdown planning and retirement planning. And of course, at the start of the tax year, we see that as well. And I think if I just sort of go on to that area of retirement planning just quickly, I mean, in terms of if you're thinking about retirement planning, please speak to your financial advisor. But before you do, I think there's 3 key areas that I think you should think about really with retirement planning. One is your expenditure. What is your expenditure going to be in retirement? The second is what are your income? What's the income going to be coming in? So thinking about defined benefit pensions, maybe state pensions as well. So that's guaranteed income sources. And then with the advisor, you see, we can look at shortfalls and start planning and using cash flow models and stuff like that to help them with that. The final thing as well with retirement planning, given it's a topic of debate really with us at the moment, is risk. And I think a lot of clients often think that when they get into retirement, their pension fund either just goes into cash completely, which is obviously you probably all laugh at that, but some clients do think like that, or they will actually just naturally de-risk like a lifestyle fund. Now, clients need to sort of think that with a pension, it is the longest term investment they can possibly have effectively, and they may not need to de-risk. So we'll go through a risk tolerance questionnaire with a client and obviously explain how that risk tolerance works and potentially just keep them in the same risk that they're in at the moment throughout the retirement, given it's such a long-term product. So those are sort of questions that we're having with clients at the moment, is more around retirement planning again, and like I said, we sort of see that a bit more this time of year. So yeah, that.
Have you got thoughts on why it is seasonal? Why do people look at these things now, and when do they look at tax year end as well?
I think with this time of year, I think people have just come back from the summer holidays, and of course summer's now ended officially now. And I think they just sort of seem to think, actually, that I've had enough now. Yeah. And that's why they have that initial chat with the the advisor really about that.
And I suppose
So-
it indicates the importance of advice as well, as you've
Yeah,
just outlined there. There's multiple things that need to be brought into consideration when contemplating changes
There is.
as you approach retirement age.
And I think if you can come to those meetings prepared, just
Yeah.
thinking about those three key areas, such as your expenditure, your income, or your guaranteed income sources, and your risk as well, it just puts you in a really good position to speak to an advisor, and then we can give you the best tax efficient advice possible then.
And I think retirement planning as well, you know, that as you get older, you remember what you were told when you were younger and pretty much ignored.
Yeah.
That the sooner you start saving for your retirement, the better. And you think, oh no, listen, okay, that's not for me. But actually it is.
Yeah.
It is. And to start saving means you're going to have an easier conversation in later years. So if you are 20 or 25 or
Yeah.
however old, just put a little bit more away for that rainy day.
Yeah.
And this is the old man talking here. The young man ignored that advice.
But it's so true. We know the powers of compounding. We discussed that in terms of last week, financial education. And if we look back at the podcast from last week, there's a great illustration of how important it is to start looking at junior ISAs, even pensions, really early in life. And maybe turning just to you, Mark, then, in terms of the advisor side of things.
Yeah.
We've had a lot of advisor contact over recent weeks, and what have been the key things they've been discussing?
I think that what we find, Jeff, talking to advisors is we get the questions that clients are asking
Yes.
the advisors, and they come to us, and it's all about information and how up-to-date that information is. You know, that it has to be current, but times are moving so quickly that it's very difficult for somebody to take a view from a fortnight ago and tell a client because the world's moved on.
Yeah.
And Chris and myself had a good meeting with about 20 advisors through the week, and a lot of the questions were around what appears to be bad news is reflected as good news
Yeah.
by the market, and conversely
Vice versa.
the vice versa. But also bond markets come up quite frequently because it's a relatively new subject to a lot of people, where bonds were regarded as the boring, safe part of the investment market, and they've performed more like equity
Yeah.
markets over the course of the last 2 years. So there's a lot of questions around that. But also, particularly for Chris, who runs the
Yeah.
portfolios, just what sort of process do you go through? You know, tell us a little bit more about your day-to-day work with not just the portfolio side of it, but with the underlying managers. How robust is the process? What challenges go into making decisions over the portfolio construction, etc. So it really is about current information and snippets that would relate to what's happening currently.
Market.
I think maybe-
there's a lot there, and I think
No.
I'll probably try and unpick that. And probably you were going to do that there, Chris. So
Oh,
sorry for
it's all right.
interrupting.
I probably spoke too long there. I'll get told off later on.
I was just going to really build on what Mark was saying, in the sense that we had a great day a couple of days ago with some of our advisors, and I do a kind of half-hour presentation to them, but I actually think some of the best parts were actually the conversations that we had afterwards. And I think for me, building on what Mark was saying around the kind of robustness of the process and the challenge that we have, we're actually about to go into an investment meeting after this, and basically the point of that, or the goal of that investment meeting, is we have put together an investment view which has come from our research, our managers' research, external research that we buy in. And then what we're doing with this meeting is basically we're challenged by everyone around the table. So for me, it's about having that challenge, which can be pretty hard. I'm sure the next meeting is going to be quite hard. But what you end up with is a much better outcome, a much more robust outcome. And we do that for every single thing that we do. So we do that for our market view, asset class view, and we also do this next week when we think around actually the portfolio positioning.
I think that's a crucial point to bring out, because one of the things that you're mentioning there, Mark, is the noise that's in markets and the want for everybody to comment on everything that's going on. Well, we kind of forget that it's exceptionally difficult to do that and to actually make rational comments around those sort of things, but actually bringing it back to process, consistency of process, consistency of challenge, allows you to focus in on the key factors as opposed to the noise. And I think, Chris, that's crucial in what you're doing with the True Potential portfolio solution.
Absolutely, yeah. I think for us, we've got what I think is is one of the most robust processes out there, certainly from my 24 years in fund management overall, and that's necessary. You know, we're going to talk a little bit in a couple of minutes about not noise, but the kind of data releases that we've seen this week, how those data releases have affected asset markets. But for us, it's about having that view.
Yeah.
That view needs to be flexible, but within that, how do we take that view, we apply it to TPP, and what's the challenge around that? And that for me is key to
And I
what
think
we
that
do.
also links into Tom as well from an advice perspective, in terms of that consistency of process and how we work through those discussions with our clients as well.
Yeah, and of course there's regulation that comes
Yeah.
into place of that from our side of things, and how we approach clients, and having that initial obviously meeting with the client, and then going through the suitability report, explaining that to them. Obviously we have the fact find as well, which is the initial meeting part, and then presenting that to them, and then obviously providing them with the regular ongoing advice as
Yeah.
well. So that's the advice process. Effectively, that's what it's called.
And it takes us back again to what I was saying before about the platform side of it, because the award that we got for Best Platform Service is not just that onboarding of a client coming into True Potential as a first-time investor or a first-time client of ours. It's the ongoing service that they get, you know, whether it's topping up the investment using the technology Impulse Save, where on average we take in something 13 to 14 million pounds a month, except when it's tax year end, and it goes up to about 40 million.
Yeah.
But having that underpinning the human touch is a vital part of the True Potential service to clients.
Yeah, I mean, I agree. I mean, if annual reviews are so important,
Yeah.
because there's changing circumstances to clients all the time, and you'd be surprised actually when you have those conversations with clients to actually forget about little things that's changed over the course of last year, and of course you can take advantage of certain changes in their life as well. So, it's certainly very, very important for us from an advice perspective.
Maybe then, Chris, bringing that back then to some of those market events over recent weeks. Maybe for our listeners or viewers, what were you picking out as some of the key events that have happened, and how should we interpret those?
Yeah, absolutely. I mean, it's been a really busy week. So I'll probably walk through 3 different events. So first event was UK inflation release. So hopefully you all will have watched my morning markets video earlier in the week, but just in case you missed it, I'm sure you won't have done. What were the key points? So the key points was that headline inflation, so UK CPI came in at 6.7% year on year for August. That compared to the previous month's data release, which was 6.8%. So only a slight drop in inflation, but I think what was quite interesting is if you looked at market forecasts and market expectations, they were actually expecting inflation to move upwards to 7%. So what you got there was actually quite a favourable inflation print. If you looked sort of underneath the bonnet of that and looked at the key drivers, what has actually brought that slightly down? Well, you've seen food prices come down, and also hotel and restaurant prices come down as well. I think one of the key things that we've been monitoring, I know we're probably going to talk about this a little bit later, is just fuel prices and how the oil price then factors into inflation. So it is starting to factor into inflation. So if you look at transport prices, when you look at what we saw last month, so the year-on-year move to July, that was shown as a drop of 2%. If we look at what that is year-on-year to August, it's now a drop of 0.5%. So you can see fuel prices are starting to factor into inflation. But I'm pleased to say we're not actually seeing that in the headline number overall. And if we look, the market was very pleased. If you look, the FTSE finished, I think it was up 0.9% on the day.
I suppose the other aspect of that was when we dig into the core inflation. Core inflation had a big surprise relative to expectations in terms of coming in at, I think, 6.2 or something like that versus sort of near 6.9 expected.
Yeah.
So quite a step change there. And hopefully for all of us, the food price element, there was also quite a material drop in that in terms of, I think when we were last talking, we were looking at something that's 17% food price inflation in the UK down to around 13% this time. So everybody that's listening and viewing, hopefully we then start to see that coming through a little bit more in shop prices as well.
Yeah. I mean, I suppose maybe should I just stick with the UK and then just move on to the Bank of England interest rate decision. So obviously talk through about how the inflation print was maybe a surprise compared to what people were expecting. Actually, the interest rate decision was also a surprise. So the expectations were for a 0.25% rise, and actually what we saw is that the Bank of England decided to keep interest rates as they were. So I'm sure you'll know this, but interest rates in the UK remain at 5.25%. I think just digging in a little bit into that, there was clearly a lot of discussion around that decision. If you look at the individual members, it's 5 members in favour, then 4 not in favour. So a very, very close decision overall. If you look at the growth forecasts, they have slightly come down. So they were around about 0.4% for Q3 GDP. That's come down to minus 0.1%. I think, we get lots of different external research that we look at. What do we think around interest rates when we look at that external research? The likelihood is that really we're very, very close to peak interest rates right now. It's not likely that interest rates will significantly move higher from here. And then what do we see moving forward is probably interest rates maybe remaining a little bit higher for longer than maybe some people expected initially.
Yeah, it was interesting that 5-4 vote, the casting vote was the governor.
Yeah, absolutely.
So he's made a call there, and we'll see whether or not that's the right call in the following months. Where for all central banks, they're data dependent. They keep saying that, so the data will be the judge. Now, I
think that's right, and I think the other, I suppose, the aspect that we've got to think about from the Bank of England's perspective is inflation in the UK is still very high relative to the US, relative to Europe. So it is a big call to have, as you say, Chris, surprised the market and not moved forward. Yeah. I suppose the other point there is, where have we most acutely seen the impact of that? It's not really been in the equity or the bond market, but it's been in sterling, where we've seen quite a material move in sterling over the past couple of days.
Yeah, absolutely. I mean, if you think of, we obviously look at sterling versus every other currency, but maybe just keep it simple against the dollar. We saw earlier in the year sterling peak out around about that 130 level. As at the start of the week, it was around about just under 124. If we look this morning, it's around about 122.7. So what you saw is that obviously the Bank of England didn't raise interest rates. Therefore, what you saw is a little bit of sterling weakness come through on the back of that.
And Chris, just for the viewers, that's important when it comes to portfolio valuations. When we've got a significant part of the portfolios invested in the US, and we'll come on to the US in a moment. The currency exchange rate is vital when it comes to the valuations.
Yeah, it is. This is going to sound really counterintuitive to maybe how people think around currency, but actually a weak sterling is good for overseas asset prices. So it actually pushes up on overseas asset prices. So you'll be thinking, sterling depreciation, what's that going to do for my portfolio? But actually in general it's positive, because obviously we hold a significant amount of portfolio exposure away from sterling overall.
It was the same argument that you had years ago, isn't it, with the exchange rate, that a weak pound was good for exporters.
Yeah, exactly. And
I mean, still, you see that with FTSE 100 performance.
And also when we go and we look at you think how Japan has performed. Yeah, Japan has had one of the weakest currencies over the course of the year, but it's been very positive for that domestic manufacturing industrial economy as well.
Yeah, absolutely. And then maybe
no change from the Bank of Japan today, is that right?
No change at all. So basically maintaining their kind of ultra loose policy. So Bank of Japan's probably quite different to other developed markets, such as say the UK, Europe, or the US, where actually you've seen very significant tightening of interest rates come through. The Bank of Japan hasn't done that, so they've kept short-term interest rates at minus 0.1%, which was very much expected, and they've capped the 10-year bond at 0%. So again, very much as everyone was expecting there. But you're right, Japan has been a really good performer for us and for clients' money.
And Tom, maybe linking a couple of those things together, we've talked a lot about interest rates there. I'm certain you've had some discussions with clients around cash interest rates and things like that. How do you think about that from an advice perspective?
Yeah, absolutely. I mean, what I'll probably cover off first really is that cash is good in some instances, first of all. So, I mean, if you've got an emergency fund, obviously we typically say around about 6 months worth of emergency fund is good. if you're a zero risk investor as well, obviously you shouldn't be invested. So that's another thing. But also as well, sometimes when you've got short-term needs. So for instance, for myself, I mean, one of my short-term needs recently has been getting married and obviously saving up for a wedding, which was only, I had 2 years to do that. So I'm not going to invest for that short time period. However, well, another thing that we use sort of cash for as well, I'm sure within the portfolios, is the diversification, and to also enable us to obviously buy assets when we need to as well. So we have that diverse, cash within the portfolios as well. But where cash obviously isn't good really, is where you're saving for the long term. And especially this comes into place with the majority of our clients really, where they'll have a stocks and shares ISA alongside their pension, and that's to supplement their retirement income, and that's what the purpose or objective is for. And stocks and shares ISA is a brilliant product to do that as well, because if you think of a pension, for pension you can take up to your personal allowance, your 12,570 with taxable income, and then you can use your tax-free cash and your stocks and shares ISA to supplement the rest of your income. Yeah. Now, in that instance there, obviously looking at these, because there are quite attractive, cash ISA rates at the moment, it's not a good idea to look at moving away into a cash ISA and then trying to time it and come back into stocks and shares ISA. And the other thing with cash ISAs as well that you've got to be aware of is obviously the inflexibility of them as well. With a cash ISA, you're in there for a fixed term. If you come out of, you take a withdrawal from that, you'll lose that interest potentially that you've made on that cash ISA. And of course, you can't take a regular withdrawal from those sort of fixed term products as well. Which of course you can do with stocks and shares ISA. So, key thing with this is thinking about the term. Anything over 5 years, where you've got a long term and you're thinking about taking a regular amount of money from that investment, of course, stick with stocks and shares.
And also, it's worth saying that cash is not a forbidden asset class within the funds that are being managed. It's a very useful way of getting liquidity.
I think that's wholly correct. And thinking about that, Chris, the average rate that we're able to earn on cash in the portfolios today is
sure. So basically, it'd be just north of 5%. Yeah. So there's three ways that we hold cash. So firstly, we hold quite small amounts of cash with our custodian. So that's used for day-to-day transactions, and you receive an interest rate on that. But also you receive the majority of the interest rate on cash through higher interest products. So what do I mean by that? We have money market funds, and as well as that, we also have short-dated bonds. So bonds with less than 1 year maturity, that's classed as cash as well. So for us, cash is a really useful tool. It's a more useful tool than it was, say, 2 years ago. But certainly for me, for an investor or a client who is thinking around the long term, the only way to make a decent return to hit your goals is to be invested in asset markets, not just in cash.
Cash is a tactical asset, and it's held within the funds exactly for that.
But it's useful, and we use it. But for me, it's not the only thing that we have. It's so important to be invested in risk assets.
I think one of the things I always say with clients is, look, if you think back to the last 8 years, and I'm saying 8 years just because of obviously our portfolio inception there, and you think the first 6 years, you're looking at interest rates at about 0.5% there or thereabouts, moving up and down. And of course, over the last 2 years, you've got increased interest rates. Now, you think about that over an 8-year period, it's not particularly great returns at all. And you compare that to, say, our balanced portfolio, it's performed well above, that over a long-term period, despite the last, couple of years, really. So it's a no-brainer for clients when they're thinking of that, longer term. It's the longer the term is, the more likelihood stocks and shares-based products are going to outperform cash.
Because we know that interest rates are ultimately very cyclical as well.
Exactly.
In the same way as markets are.
And that's the thing as well, you've got that interest rate risk there. That when you come out of that fixed term period, the likelihood is that the rate that you're going to be offered after that 2 year period is going to be a lot lower than what you're offered now. And that's something that clients need to understand.
And there's also,
as well.
I suppose, quite material, if you're not in a tax-wrapped vehicle, interest income, there's a very significant tax associated with that as well.
That's one of the things that a lot of clients are coming to us and saying about bonds at the moment. And of course, if you've got a bond, any interest that you make, and say if you're a higher rate taxpayer, you could be taxed obviously 40% on that growth that you've made within that bond there. So you've got to be really careful with those sort of products.
And again, that's where advice is really crucial to making any of those types of decisions. And maybe, Chris, just coming towards the end in terms of then how asset markets have performed over the last couple of weeks and how that's influenced the portfolio return. Can you bring that to life, please?
Yeah, absolutely. So maybe if we just sort of look what's been happening over the month. If we look, we can see that equities have outperformed fixed income. If we dig into the kind of key regions that have done very well, Japan's done very well, but maybe also building on sort of what Mark was saying a little bit earlier on, the FTSE 100 has also done well. So kind of one of the big key features within markets has been the strength of the oil price. So if you think, so Brent from what end of June was around about $70 a barrel. As at today, it's just under $94 per barrel. The FTSE 100, the index composition tends to be more focused around commodity producers compared to many other indices. So that's been really beneficial. And then the second reason why the FTSE 100 has done quite well this month is exactly what you were saying, Mark, which is around the currency. So we've talked a little bit around how you've seen some sterling weakness. Obviously, if you're an UK company that is selling products to overseas markets in their currencies, then actually it means that they can buy your products at a cheaper price. So that's been quite beneficial. Just within bond markets, what you've seen is in general within sovereign bonds, that the UK has been the best performer, which has been one of the kind of key trends that we've seen with the managers that we work with, and also some of the trends that we've been exploiting ourselves. And probably the big theme within bonds is just basically that investors have been rewarded for being positioned shorter duration compared to longer duration. Now, what do I mean by that?
What do you mean by that?
Yeah,
Exactly.
I knew you were going to ask that. Yeah. So imagine you're an investor, you're buying a government bond. Basically, you lend to, let's say, the UK government for a certain period of time. So if you lent to the UK government for, say, 2 years, that's a short period of time. So that's being more positioned short duration.
Yeah.
If you decide to lend to the UK government for 30 years, that's position longer duration. Now, longer duration is generally more sensitive to interest rate movements and expectations of interest rate movements as well. I guess, what's been happening within corporate bonds, within credit, a little bit of sort of mixed performance there. But what you've seen so far this month is that investors have been rewarded for taking risk within their credit basket. So what you've seen is high yield bonds have been the best performer overall. Currency, probably the big thing that you've seen is exactly what we were talking about before, which is that sort of sterling weakness come through. And probably just within currency as well, just on today, we talked a little bit about the Bank of Japan's sort of non-decision. It is a decision, but not moving anything. You had seen a little bit of yen weakness come through. Yeah. And that is, again, because Japan is choosing to keep that loose monetary policy, which is different to other regions.
It's a big outlier, if you will, in terms of what's happening in policy markets globally, isn't it? Okay, well, thank you, everybody, for joining us today. Hopefully our viewers and listeners have found that informative. If you have any questions, as we've discussed, please do get in contact with us. But thanks for watching.